Hi, I'm Campbell Harvey and I'm teaching global financial management. I've been in finance for about 10 years. This is my 10th year teaching finance. I obtained my Ph.D. from the University of Chicago, and let me maybe tell you just a little bit about my research interests and background. I began my research actually during my MBA. I wrote a term paper on the relationship between interest rates of different maturities and the economy. And this turned out to be my thesis at the University of Chicago. And what my thesis showed was that the difference between a long-term interest rate and a short-term interest rate, and this is sometimes called the term structure of interest rates or the yield curve, had a remarkable ability to forecast what happens in terms of economic growth in the economy. And my thesis studied data going back actually centuries. And I focused my attention on the most recent data when the interest rate data were the highest quality, and found that this simple indicator of the business cycle yielded no false signals. And that was kind of remarkable because most indicators tell you there's going to be a recession, and the recession doesn't materialize at least a few times. My indicator was more accurate than the leading econometric models, where people would subscribe and pay thousands of dollars to get their forecast. My indicator was basically free and available from a simple calculation from data in the Wall Street Journal. So I published this thesis in 1986, and actually I had to stand by its predictions in 1989. Rather unfortunately, I called a recession, and it turned out that there was a recession. And the indicator forecasted exactly the length of the recession and the timing of the recession between 1989 and 1990. And so far it has not yielded any forecasts of recession, and there's no forecast of a recession in the near future, and that's 1997. So we'll have to see how well it performs. But I moved on from this type of research to international finance. In particular, what I do in international finance is known as active or tactical asset allocation. So I research ways to invest that allow for time-varying rewards in different countries and risks in different countries. It's very much a dynamic investment strategy. And there's a model for every single country. It's quantitative in nature, and it's much different than the traditional buy and hold approach to global investment. So my approach, you would be varying the weights in different countries. You might be totally out of a country in one quarter and then back into the country in the next quarter. The weights or the country allocations change through time. This is sometimes referred to as dynamic asset allocation or tactical asset allocation. And I've written some academic papers on this, and a lot of my consulting is focused on giving advice as to where and when to invest. A lot of my recent interest has to do with the emerging equity markets. And I published a paper in 1995 called Predictable Risk and Returns in Emerging Markets in the Review of Financial Studies. And this was perhaps the first academic work that studied the risks and returns to emerging markets. And there have been some practitioner work detailing some statistics about emerging markets. But nobody had really examined in great detail how the risks of these markets change through time. And I actually found, and this is very much within the framework that I use for global investment strategies, that these markets tended to be more dynamic, in that the risks were shifting often more dramatically in the emerging markets than in well-established developed markets. Hence, these methodologies that I propose to do dynamic asset allocation through time are perhaps more appropriate in investing in emerging markets, where there's a lot of things that can change very rapidly. So I focused on emerging markets, and actually the very most recent things that I'm doing have to do with assessing country risk. And in finance, we're always concerned about the trade-off between risk and expected return. So all of our asset pricing models have some foundational aspects that are related to expected return and risk. However, in a lot of countries, it's extremely complex to measure the risk. And on top of that, as I've shown in my research, this risk could shift through time, perhaps quite drastically. So what I've done is I've tried to develop a framework to analyze country risk in as many countries as possible. And this is useful for the portfolio investor who would be trying to decide how much to invest in a particular country, or whether the rate of return looks decent in that particular country given its risk. It's also useful for the practitioner of corporate finance. The practitioner of corporate finance is trying to assess whether to make a direct investment in a country, perhaps building a plant in a particular country. And a critical piece of information is what is the required rate of return on such an investment to make it worthwhile. And this is exactly what my analysis of country risk produces. So I produce a risk measure, I produce an expected rate of return that an investment of average risk within that particular country should achieve in order to make the investment worthwhile, or as we'll come to call it later, to have positive net present value. So I focus on country risk and returns and dynamic investment strategies, and that's really where all of my research is focused. I have the advantage of knowing and seeing a lot of research actually before it's published through my editorial appointments at the Journal of Finance and the Journal of Financial Economics and many other international journals. And what my teaching strategy is to try to bring as much of the unpublished research as possible into the classroom. And it turns out that this unpublished research will be published probably in a few years, and then there's another 3 or 4 year lag between the publication of the research and the actual adaptation of the ideas within the research. So what I try to do is to give my students perhaps a 5-year advance window on what's going to happen in finance. And I try to be fairly aggressive in terms of doing that. So we focus on really the future of finance rather than some things of the past. And this is challenging for the students, there's no doubt, because often some of this recent research is quantitative and quite difficult to master. But we try, and that's really my teaching strategy. So there's a little bit of my biographical background, and let's get on with the course.